The turn is happening. And those who think that things are getting worse simply because they haven't seen them get better yet will come in at Dow 12,000 instead of Dow 11,000. And you know what they're going to say? They're going to say to all the people on TV, all the gurus, why didn't you tell me things were getting better? I would have been buying. And for that, I will happily plead not guilty because I think it is most surely happening right now.
How about a little help? You got to love that guy. The market staying above 11,000 for the Dow today, and the S&P breaking 1,200 for the first time in almost 19 months, guys. The street shares Cramer's optimism, but can it continue? Let's gather our Power Lunch market insiders, Charlie Smith, Chief Investment Officer for Fort Pitt Capital Group, and Bob Iacchino of LotusBrokerage.com. Charlie, you sound a little wishy-washy on this market. You're saying the S&P will peak this year at 1225. That's only 25 points away. Why aren't you happier?
Well, we came into the year with that target, and we're bumping our numbers up. Our earnings estimate for the S&P is now going to be 75, 77. If you put a 17 or 18 multiple on that number, yes, you do have further upside.
How further?
Well, we're talking somewhere in the 1280 to 1320 range at least.
1280 to 1320. He's getting the religion, Bob. And what do you say?
Well, and, it's mostly...
Bob.
Yes.
What do you say? Charlie's getting the religion. What do you say?
Well, I say I'm not religious, but I'll tell you this, I have the same sort of resistance target at about 1224 in the S&P. It's interesting what Jimmy said yesterday after basically a 20% move in the S&P that the turn is here. That implies to me 35, 40% by the end of the year, and we're talking about a duration story. I agree with Jimmy. Okay, I think the S&P, the Dow, the stock market is strong. I'd like to see a couple more triple-digit days in the Dow than we've had over the last 27, 30 trading days. Okay. But I'll tell you what, I agree with him on the turn. The bull is back. How long it's going to last, it's a duration story here.
Charlie, you said that you have raised your estimates for the S&P 500. That makes you raise your estimate for the earnings estimates. That makes you raise your actual final target. What pushed you to raise your earnings estimates for the S&P 500? Was it the earnings that were out today? Is it the GDP numbers that we've seen? What?
Well, the continuous gains in productivity that we're seeing are really unprecedented. Intel's quarter was interesting in that they reported their operating income per employee hit an all-time high today. That's ahead of the numbers from the mid-90s. So a new peak in all-time operating income per employee for Intel, and we really haven't even gotten going in the cycle yet, tells me that the profit surprises, particularly in tech, are going to continue.
That is a great, great data point.
Bob, let me ask you a question. Why do you think the Dow has been trailing the other market indexes so markedly? Not to say that the Dow's gains since last March are anything to sneeze at. They're very good. But what is it about the Dow and the particular constituents there that make it less sort of robust than the others?
The Dow is the retail investors' barometer, and they're not back in yet. They don't have their jobs yet. We're just seeing the jobs market start to bottom. You're going to have a hard time getting this sort of tiny generation of investors that got hurt over the last two and a half years to jump back in. They need to get their jobs first. As you're seeing from retail sales, American consumers are purchasers. They're users of goods, and when they do start to get their job back, the first thing they're going to do is they're going to take advantage of things they've deprived themselves of before they get back into the equity markets. The Dow is the index that the retail investor watches and invests in because it's the easiest one for them to understand. NASDAQ and S&P are going to lead us.
All righty. Charlie, Bob, thank you very much.